And welcome to today's edition of the Lance Roberts Show podcast. You know, one of the interesting discussions that has been happening as of late is whether or not the bear market of 2018 is now over. Jim Cramer came out today, said, hey, December the 24th, that plunge on the half-day Christmas transaction day, that was the bottom of the bear market. Jeff Gundlach, of course, manager of the multi-billion-dollar Double Line Total Return Fund, says that no, actually we have entered into a bear market and there is more to come on the downside. So from an investment standpoint, as for investors as well as traders, the question is right now is, well, is this rally that we've seen since the beginning of this year, is this the return of the bull, or is this more of the, just part of the bear process that is still underway? And to discuss this a bit more today, I'm joined with Michael Lebowitz, certified financial analyst, talking about, well, has the market actually entered the bear's den? We actually have a report on this at riapro.net. That's our professional version of our website, riapro.net. You can subscribe there for absolutely free and for 2 weeks and take a look at this article. But we're going to discuss this in a lot more detail today. Mike, as we look at the markets here, we've had this nice rally since the beginning of this year. Markets are up about 10% from the lows, 11% from the lows. But you kind of think here that basically we haven't left this bear market that started last year.
Right. So what's very interesting, and you brought up the Jim Cramer quote, is that it's that very volatility, both the down move into Christmas and then the sharp rise after Christmas, that actually leads us to believe that we are potentially entering a bear market. It's not the rise since Christmas that has given us hope that there is no bear market. It's actually quite the opposite. As that it may sound weird, but as we discuss in this article that we put out today, it's given us, the market has given us all the signs of a traditional bear market. We do two things for the most part. We look at fundamental analysis and technical analysis, and we share those opinions with you all the time on Real Investment Advice, on RIA Pro, on these podcasts, on the radio. And we have been warning for years that from a fundamental perspective, stock prices are overvalued, and we've been flashing the red light. But we have never said to sell based on that. That has never said we're going to immediately be in a bear market. We have been waiting for the technical indicators, which we put out all the time in the newsletter, in the Tuesday technical update. On RIA Pro, we have them every day. And we've been waiting for longer-term technical indicators to tell us that we have entered a bear market. And while we're flashing yellow, we still haven't got there yet, but we are getting pretty close. So there's a third one, and we talk about it less, but it's very meaningful. And Jeff Gundlach made a quote, and he said, a bear market is determined by the way stocks are acting. So acting, to me, is the sense that we get from the market, the way that there are moves that remind us of moves from days past. So back in September, remember, the market started falling very early. I think it was October 3rd. Prior to that, Lance and I were talking every day that this market is starting to act weird. We would have days where the S&P was up 15, 20, 25, even 30 points and close the day flat, maybe slightly up or even in the red. And we were saying something's going to happen here. And sure enough, come October, the market started on what would be pretty much a 3-month decline. So that got me thinking that sense and gut are nice, but most of our viewers don't have all day like Lance and I do to follow the markets, and they don't have the 30 years experience that both of us have in the markets. So how can I quantify the gut, the sense, the way stocks are acting, according to Jeff Gundlach, a little better? So what I did, and we can look at the first chart, is take a look at the S&P since 1970. And you can see that there have been essentially 5 bear markets, I'm sorry. It's hard to see, but 1987 was one, even though it was very short in duration. And we use those numbers. The green numbers are the periods of expansion, and the red numbers are the bear markets. And we'll use those in a second in the table. But before we even get there, what I would notice is that bear markets are not common. Bull markets are common. Markets tend to rise. And we're going to show you the behaviors of the bull markets versus those of the bear markets and why distinguishing between the two is very important. So let's move to the table, which shows on the left we have those bull markets, numbers 1, 3, all the odd numbers from 1 through 11. And then we have the bear markets. Now, as you'll see, number 12 is a question mark. We are not in a bear market, but I wanted to put the numbers on the bear market side so we can compare them. And we're looking at this two different ways. The first is, and we call it the average 20-day difference, min versus max. And what that does is tell you the minimum and the maximum price levels using intraday pricing for 20-day periods. So over the course of approximately a month, what was the highest print, and it's intraday, and what was the lowest print, and what's the difference between those? And you can see that during bull markets, it's on average about 6%. Then if you look to the right, you can see in bear markets, it's almost double, close to 11%. So the takeaway there is that the ranges over 20-day periods are much bigger. Then we use a more common average annual volatility. This is the same volatility that we talk about with the VIX and other volatility type products. And you can see that the average volatility during bull markets is 13. And actually, over the last few years, called 2016 to 2017, we've been running at times below 10. But nonetheless, the average is about 13. And then you look at bear markets, and again, it's close to double at 22%. The other thing is look at the current on the bear markets on the bottom right. You can see that since October, the numbers, both the average 20-day difference and the average annual volatility, look very much like all the other bear markets. So that's one reason that our guts have been telling us, in addition to the technicals and the fundamentals, that something is changing, something is different.
So Mike, let me ask you a question about this first chart that you had looking at the S&P versus the bull and bear markets here. The one thing to really note, and I think is an important point that we need to bring out most importantly, is that if you come back here and look at the early cycle of these bear markets, 1973, 1974 bear market, of course there were two bear markets prior to that in the 60s, that was during a period where we had a period of valuation contraction. In other words, valuations were high. They were beginning to fall in 1974 when we got to the end of that bear market period. That was when valuations had mean reverted back to 9, 10 times earnings. During the 80s and the 90s, even though we had this kind of long extended bull market, that was a period of valuation expansion, which is very important in the sustainability of a long-term bull market where you only have minor corrections. In other words, you only have declines of 10 to 20%. The bear market of 1987, everybody looks at that and says, oh, there was an 87 event that we just had. But the difference there is that valuations were still low and expanding versus where we are today when we start looking at the current cycle over the last really 18 years. We've been in a consistent period of high valuations, currently now still trading at 27, 28 times earnings, which have tended to foster much bigger corrections than you have when you have low valuations that are rising. Is that right?
Correct. I mean, this is where the fundamentals play a big role. We also are in an economy where growth is 2.5%. It's been higher the last couple quarters, but we're trending in that 2.5% range. Mm-hmm. If you go back and look over those prior sell-offs, they were all higher. So it's economically, it's the debt burden, it's valuations, it's everything fundamentally is telling us. That's why we have our red flashers on for all of the fundamental reasons, and we're waiting for our technical indicators to confirm that they are flashing red for a reason. And then we have these what I would call gut type indicators, which is our sense of the market and what the market's trying to tell us.
Right. And, one of the big challenges here for investors is the problem between the longer term outlook versus what happens in the market short term. And again, despite the fact that as investors, we all say, oh, we're a long-term investor, the reality is that we have now been trained to really look at the markets on a monthly, daily, even, how many times a day did people check their portfolio already? We check it on a regular basis. We're constantly monitoring it. What did it do for me today is the problem. And one of the problems here is when we talk about bear markets, immediately people drop in this attitude of, bear markets happen and it's, the market's rallying right now and this is going to continue for a long period of time. The problem is that extrapolating current trends into the future are always problematic because we can't really predict what happens in the future. So, understanding the dynamics that drive bull and bear markets is critical, but it's also problematic for investors to apply that to their portfolio.
Right. And investors, not speculators, not traders, but investors need to be patient, and they need to be prudent, and they need to be aware of these signs, and they need to take actions both bullishly and bearishly, depending on what those indicators are telling them.
So, Mike, one of the big issues that has been a telltale sign of past bear markets and bear market cycles. But one of the issues that also weighs on investors is volatility of price. We saw a period early last year in 2018 where, the markets went through that correction early in the year, and you and I had several discussions. We wrote articles about the fact that even though the market had declined by 10%, volatility had never risen. We didn't see a rotation into bonds, the traditional move into safety. And, gold prices, another kind of safe haven type investment, didn't really gain any traction. The difference this time is that we have seen a pickup in volatility. Gold is performing better, and bonds have seen a rotation, that flight into safety. So what is volatility telling us now?
So just to go back, in the first quarter, we saw a spike in volatility that lasted days, literally 2, 3, 4 days, and then it came right back down. What we're seeing now is a sustained higher level of volatility, which is telling us, again, something is different this time. So we have another graph which looks at, it's similar to what we're doing with the 20-day min-max, but it just looks at the daily closes and the average of the daily closes over 20-day periods. So it's not the intraday movements, but just how is the market moving up and down on average. And we married that with the S&P, and you can see the columns show those same bear market periods. And what becomes apparent is that when the market sells off, the daily up and down movements increase sharply. Again, it's the same story, just being shown a different way. We also, in the article, do this, we've shown it 3 different ways now, but I think this table that we're taking from our friends at Odd Charts is just fascinating. And it shows you just the up and down movement. So when we're in a bear market, yes, in 2008 and in 2000, we dropped 50%. But it wasn't just a drop to 50%. There were some incredible swings up and down. And what he captures so well in this table is, looking at 2000 to 2007 to 2009, we dropped 18%, up 12%, down 40, up 18, down 25, up 24, down 27. And most of those in very short time frames. And that's what we need to, if we are, and this is why it's so critical to understand if we're in a bear or a bull market. If I could be guaranteed we're in a bull market, I would advise to you and to our clients that, look, we're going to buy, we're going to hold. And yes, it may be uncomfortable for a few days or a few weeks, but we're in a bull market and we're going to see higher highs eventually. And our returns will be, any losses are very temporary and will be captured. If we're in a bear market, from an investor's point of view, we could be looking, as we did in the last 2 bear markets, at declines of 50%, maybe more, maybe a little less. If you are a trader, this is a great opportunity for you, but it can also be very dangerous because there are some incredible swings in price, both up and down. So we urge people trading the market to use stop losses, to use other limits, to use other risk precautions, and trade carefully, but there are some great opportunities in bear markets just due to these violent swings in price. And to sum this all up, what we've seen over the last few months looks very much like a bear market. This is the rally we've seen since Christmas. looks like a bear market rally. We have never seen a 5% daily gain in a bull market, and we had one of those right after Christmas.
So, Mike, this is really great information. Of course, Mike and I manage the portfolios for RIA Advisors and our clients. And Mike, while the fundamentals definitely kind of show this idea that we are moving into a bear market, and kind of our gut tells us that as well. I mean, we've had a 10-year upcycle in the markets. Markets do have, unfortunately, they have two halves of every cycle. We have an up cycle and a down cycle, and you don't complete the full market cycle till you get the other half. And while a lot of advisors and a lot of mainstream media suggest that, we're into another 10-year upcycle in the markets, our gut tells us that's probably not the case. But importantly right now, and particularly when it comes to our client portfolios, we still maintain exposure to the market, although we are carrying more cash and more fixed income now because our technical indicators have not confirmed yet that we're in a bear market. They are getting close. We are getting some early indications of that. But the price action of the market itself has not yet gotten us to that bear market stance just yet, where we're holding a lot of cash and a lot of fixed income and very little equity exposure. So, and this is important to understand, is that just because a view may be bullish or bearish, and when you take a look at what is happening economically, fundamentally, technically, everybody has a view, everybody has opinions, but what's important is to marry those broader macro view opinions to a tactical approach to managing money, because we have to make money in the markets, but we have to do that with a point of capital preservation in mind, because getting back to even after a bear market is not the same thing as making money. Mike, thanks so much for your time today. We appreciate it. And of course, you're listening to the Lance Roberts Show podcast. Get all of our podcasts on our website at realinvestmentadvice.com or on our YouTube channel at the Lance Roberts Show. So until next time, thanks for watching the Lance Roberts Show podcast.